So, good afternoon, everyone, in the post-lunch session on this topic, which is journey of India's over the last 1 decade. And at the outset, first of all, I would like to thank CA Ketan Saya sir, CA Jinal Savla madam, and entire WIC team for giving us this opportunity to be on the panel for this discussion. And I'm also privileged to have two very expert panelists on this subject. So CA Vijay Manyar sir, as we have just seen, his profile and the experience. So he's also having a practice experience as well as he has been on the audit committee and the boards of many of the listed companies. So I think we will get that perspective, like how audit committee looks at the auditor from the other side of the table. So we are fortunate to have him on the panel, and Prashant Bhai is from the practicing side. He is into day in and day out into the audit profession from last so many years. So definitely he will be giving the perspective from the auditor side or how the Ind AS has evolved over the years into the practice side. So sir, as you have been in the profession from last so many years and senior to all of us, so definitely you would have seen like before IGAP, before accounting standard era, and then last 1 decade of the Ind AS era. So how the Ind AS era has evolved over a period of last 10 years. So can you please share your thoughts on that?
So thank you, Jatin. First of all, I would like to thank WIRC Chairman Ketan, Secretary Jinal, for giving me this opportunity to share my thought. I understand this celebration is across the country, so all the branches are celebrating. So it's a great day for CA uniform celebrations across the country, and I'm fortunate to be part of this celebration. So coming to the journey, 1 decade, if you go back, everybody was skeptical. So many years, as a country, we would have deferred, IFRS. It was not called Ind AS, it was IFRS, and IFRS was supposed to be implemented by the, Indian corporates. However, some or the other push or the enough push was not coming. But somewhere, since there was a delay and there was a lot of pressure from the international community, and hence, this got introduced. Lot of skepticism, I understand, lot of workshops would have been done. What are the implications, how to go about doing it. Everybody would have had several sessions with the clients. There was no experience in that sense available, except those who would have done some kind of reporting to the parent who is outside the country, and for subsidiary or associates or joint venture which is in India. So there is some flavor in terms of what IFRS is there. However, as a profession, we rolled up our sleeves, and credit to the institute, for giving a lot of guidance in and around, how to go about implementing. The concern of the corporates were, how my balance sheet is going to be looked like, and how my profit is going to be, will appear in future. Similar concern was also there when IFRS was implemented. There is one unique item which is there is, other equity or other comprehensive income. Now, what is that? If we think about it, IFRS is on a fair value. So everything needs to be fair value. And there also there was a volatility which was coming in, IFRS. And hence they came up with this, that okay, the balance sheet is right, but part of the volatility can be insulated by parking it as OCI. And that was one thing which, you know, so as I said, we also had the similar concern. Uh, Other, you know, overseas or accounting standard, those adopting, say, IFRS or US GAAP, they also had similar concern when those were implemented. And hence this concept of other comprehensive income came in, and that is what, you know, we are used to. So just to insulate, because IFRS Ind AS is everything is on fair value. Then there are certain other nuances where there is an impact which happens. Some of them, because it's not a session, but I'm saying I'm just going back as to what were those concerns, you know, during those times. So one was this in Indian GAAP we were more on the form. So preference shares or any financial instrument, the corporates would want to see, because IFRS is more of a fair value and the substance. So how do you split between debt and equity? So if my leverage is increasing, what is going to be impact on my borrowings, and how my lenders are going to look at it? So that was, you know, other areas of concern, and those were addressed. Now it is all coming, you know. The third is revenue. Now, revenue at that time was less. It has come more with, Ind AS 115. But that time, you know, is my revenue going to change? If there is any finance component in the revenue, then how it is going to impact my revenue? Because revenue is the biggest item in the financial statements, and everybody looks at it. What is the revenue? So if that revenue were to change, then how is my stakeholders going to, you know, deal with it? Couple of other hot topics were, how do you get into some ECL? And it's still, you know, it's more of an art than science, I feel, because ECL is still evolving topic. There is a lot of judgments which is coming. Even NAFRA has come with the guidance on ECL, but that ECL, how to compute, how do you develop that model? You know, what is the country risk, and what is the economy risk, and what is the sector risk, and what is the risk on the company, and the risk from the customers, and how do you provide those ECL? So I'm saying this has been the journey which over the years, and then there were disclosures. If I were to see, you know, those 4-5, large ticket items, and those were the disclosures, and how do one gets around the disclosures? There were learnings, in the initial period, but I think as a country, you know, we have mastered this, and I could be wrong, but according to me, India would be the country which is with the highest adopters of IFRS, because none of the other countries have this size of corporates, because they're only the large size corporates will get into IFRS or US GAAP. Otherwise, it's a local this which is there. But as a country, India would be one of the highest adopters of IFRS, and it's time for us to give it back in sense of, you know, developing newer standards. So I'm seeing the journey from being the learner. We should, you know, go to the how do we give it back, and how do we give those kind of comments taking into account the Indian conditions.
Thank you, sir. So it is really nice to know that over the 10 years, Ind AS has evolved. Some of the things have settled down, but still, as you mentioned, things are still evolving, and we have to take learnings from it and take it forward from here on for the next few decades. So now, Prashant bhai, I would like to know your views, like what are the major learnings over a period of last 10 years in your views?
Enormous learnings have happened over last 10 years. And one of the starting point is that how do you, in fact, start learning Ind AS? And that was one of the most important point self as a professional, because we studied IGAP when we did the exam. And nobody had an experience, as sir rightly mentioned, and we were now thrown up with a new set of accounting standards. And the one approach which I felt helped was to thoroughly study IGAP first, understand the differences, and then move. So a step ladder approach. and that is something else. Obviously, there are a lot of conferences and training programs and discussions, the material which is available, that also helps. But that is one learning, that a self-study and such a large transition where we have to unlearn what we thought was right in IGAP and adopted a new practice, and that transition was possible because there was a lot of skepticism, but that was one of the biggest learning, that we could handle such a large change, and that was one very important learning. Institute played a very important role by the ITFG which were issued. That body played a very important role. Numerous clarifications came on the implementation challenges, what are the due dates, what is the definition of net worth, how it should be counted, how does it apply to subsidiaries, JVs, in case of acquisition, from what date, what period. Lot of clarifications were given and they were really helpful, and that started the journey for a smooth transition. One area of very critical learning is prior period items, because in IGAP when we prepared the accounts, if you identify an error or an omission, we just had a disclosure or a line which said that there are prior period items, or on the face of the balance sheet you used to disclose that. But when you look at the Ind AS perspective, that is a very big change, because you need to restate the accounts, and as you go in a restatement, your accounts are looked at in a very completely different light. And even in last 10 years, you will not see so many examples of a restatement. Even if you go and search, you will definitely get a few, but it is not that it is very common thing to restate the accounts. And hence, as an auditor, what controls, what processes you ensure are there for the accounts you do not have any prior period items, either income or expenses, or major reclassifications which are happening even on the asset liability side. So this is one very important learning. Second important learning which has happened is how do you choose the accounting policy. And sir was giving an example of investments fair value. For equity investments, there is an option where either you take it to profit and loss account or you take it to OCI, and those is a matter of a choice at the point in time. And I have seen examples when company said that we don't want volatility, we will take it through OCI, but after a couple of years there was a large profit which happened, and then at that point of time people are wondering why did we do this and why we did not take it to P&L, because now it is not the profit is not forming part of my P&L, neither my EPS also gets impacted with this. So why did we select that accounting policy? For real estate, you can look at whether a percentage completion versus completed contract. Yes, obviously the underlying contracts play a role, but those type of choices what you make a very large difference. So you need to be careful at the time of making such choices. Second learning which I think is very important is not to copy paste, because that has been a common error which has happened across last 10 years of copy pasting. The disclosures are very large, the accounting policies are very big, and the common practice is that you take any good company and start copy pasting everything and anything, but it may not really be applicable, and the accounts become such a long list that nobody is really reading, and it gets copied from one year to another year, and that creates a culture where errors keep creeping. And I think that is something that we should avoid. It needs to be looked at very seriously. So this is another area of experience which we had over a period of time. Continuous learning and training of the team is another very important area which we have to do, because the Ind AS standards are also evolving and changing. When the Ind AS got implemented, there was no 115. It was Ind AS, it was IAS 18, and then it became 115, which is a very large comprehensive guide on revenue recognition. Similarly, the lease accounting standard did come somewhere in between. So those changes you have to adopt on the way as you move forward. So that is another area where unless you are trained, you keep yourself updated, there is going to be a challenge. So these were some of the challenges and the learnings which we saw over the last 10 years.
Thank you, Prashant bhai. So, sir, as first time adoption has happened 10 years back, and I think more or less now listed companies have settled down from that phase, and now they are on, we would say it is on a auto mode going for the Ind AS, subject to certain amendments and the changes which are coming in. But nowadays, as we see, lot of small and medium-sized companies are coming up with an IPO, and they are going public maybe because they have a private equity investment in the company, they have to give exit. So, and the other sector, insurance and banking, which will be now soon coming into the India's perspective. So, how they should gear up themselves, how they should prepare themselves, and as this require a lot of skill sets, and the enormous task is there ahead of them. So, how they should take this and how they should move forward, in your views?
So I think a very valid, question, and lot of companies planning to come public or getting acquired in the process. So how do they gear up? And that's so how do one moves from Indian GAAP to say Ind AS? So first of all, one has to evaluate what is the impact, because I might, the company may take a decision based on the numbers which is Indian GAAP. What is the impact of Ind AS and how those numbers look? I think that is very fundamental, because that is based on those numbers and the leverage. So that is what is the debt equity, what is the net worth based on Ind AS, is that whether one is willing to proceed with that process. So that number crunching is one of the first, very important tasks, and to sit with the bankers to say that this is how my, financials are going to move. See, fortunately or unfortunately, nobody looks at cash flow. And if you see, the cash flow under all GAAP is the same, by and large, because cash flow is a cash flow, right? And when I wear an auditor hat, it's the most important way of analyzing the company or planning for the audit is first the cash flow. Unfortunately, the process is the cash flow is prepared at the end and not at the beginning as a part of arithmetical exercise. But once one evaluates the cash flow, that one gets the insight as to how the cash has moved. But that's a discussion at some other time. But what I'm saying is, first the number crunching, which is important. Secondly, lot of times the MIS is based on, Indian GAAP. And how do we move from that MIS to Ind AS, MIS as per Ind AS? It is not must, but it needs to be some kind of reconciliation which is required. My experience, lot of companies would tried initially to go with the flow and say that, okay, whatever, so Indian IFRS is different, but we'll continue to look at MIS in the same way as we were looking earlier. But over the period, most of them have changed the track, because no point in, what the stakeholders are looking at the numbers, and when, as a company management, they look at numbers which are different. Ultimately, over the period, everything gets aligned. So idea is that sooner this MIS is aligned with the Ind AS requirements is better. It's a bit lengthy exercise, so it's a game of patience. However, once goes through that patience, because of this lengthy exercise, the impact is on 4-5 big ticket items. Correct, not much. But the idea is one has to go through that motion to evaluate that, are there any, adjustments, which have been missed. The next is, who will help in conversion into Ind AS, because probably the management does not have the competency of the staff to understand the implications of Ind AS, on the company. So initially, it's an opportunity for experts in the profession to go and help the company. But it is by and large not sustainable, because once the company is planning public, then it has to be done on a quarter-on-quarter basis. So that is where the internal, development of that competency is, important. And the sensitivity increases because the stakeholders, so lot of, stakeholders are looking at the numbers. So earlier the option was, as he mentioned, about 12 months one can look at prior period. Now quarterly numbers are looked at, and if there are numbers which there is a material variation, those also needs to be explained. So the importance of churning the right numbers on a timely basis, quarter on quarter, is something which that kind of depth and analysis which is required. And last but not the least, if the company is on Indian GAAP and will move to Ind AS, one can have some manual adjustments in initial period, but ultimately the tech will have to come and play, take over. So how was one engage or implement that tech so that quarter on quarter correct numbers are churned and there is enough time which is given to the auditors to come and review. So I think these are the few things. A lot of experiences is there now, so it's a process. It's a time-consuming process, but everybody will have to go through that process.
You want to add anything, Prashant bhai,
On this, what the thing which is there is that if you understand, as you were saying, that there are mainly 4 or 5 items which is going to change. So it is not something which is so scary, but just to breaking down into small pieces really helps. And that has been my experience where I have helped various companies go into the Ind AS regime, identifying the impact initially, 4 or 5 key impacts, not looking at very, very small items, and doing the restatement and then taking it forward. I think that is something which has been very useful.
Continuing with this first time adoption and the initial changes which have happened in the new companies. So going forward on an ongoing basis, how they should look at the things and what all things they will have to ensure so that there is a smooth transition going forward.
So initially, maybe there are chartered accountants who have helped companies transit from IGAAP to Ind AS. But on an ongoing basis, quarter on quarter, if your results have to be published, now there are debt equity, debt listed companies, even private companies have their debt listed, equity listed. So both the scope of Ind AS is getting increased day by day, and 250 crore net worth nowadays is not very, very large. And there are a lot of companies across India where it gets applicable. And hence, generally now what we have seen is that the proportion of Ind AS implemented companies is increasing day by day. One thing which all the companies need to take care is the discipline of accounting. It is very, very important. Second, the team which they need to have sufficient training or at least basic understanding that these have Ind AS implications. So for example, if you are entering into a new transaction, the team must be aware that there will be some Ind AS implication, and let us look at that, because from a tax point of view that could create challenges, because your profit as per Ind AS accounts may be very, very different, and what the tax authorities will look at it is very, very different. Those type of challenges still keep on coming up, and identifying those early at the time of the transaction getting entered helps, because then you can suitably address those areas, or you are mentally prepared that this is a challenge which is going to come. During the last 10 years, we have already seen 2 other transitions. One is the lease accounting and 115, where it was another mini transition which happened for many companies, and that has also successfully been addressed. Use of tech is very important. Sir also did mention that your ERP systems need to be upgraded. You cannot do everything on Excel. You cannot do everything manually. Consolidation has become a challenge. Earlier, consolidation through Excel was possible, but now if you are a large group, consolidation through Excel becomes very, very difficult. And you may have a lot of subsidiaries which may not be companies. And those LLPs, partnership firms also gets covered under Ind AS because they are part of the subsidiary structure. And how those type of entities, because there the infrastructure may not be as good, the accounts team may not be good. So again, proper guidelines, training is something which is must.
Okay, so as you said that they should have, so initially the consultants are there, so they are helping the company to do all these initial changes or whatever implementation related things are there. But if we say then for the small companies it is not possible because they don't have that much skilled manpower or skill set. So how this is to be taken up, like what all things they can do to improve on these things, or how they can stay updated with the changes or the amendments which are coming up.
One thing which people can do is to have proper templates. So at the time of implementation, doing it first time right, creating a proper template which can be used multiple times. So even if your team is not an expert on Ind AS, but if they're able to fill up those templates, then your Excel sheets will automatically take care of lot of things. So using that, so it helps doing the repetitive things easily. And as I said, there are 5 or 6 critical adjustments which have to be focused at. So if proper guidelines are issued, that these are the 5 things which needs to be taken care. For example, if the revenue needs to be broken up into 2 parts or a financing component needs to be eliminated, those guidelines for working out those or predetermined formulas in the Excel sheet, where if the figures are pulled out from the ERP software, automatically the numbers will get worked out. That is some of the modes which a smaller company can definitely use, and eventually as they grow, this can be put through a proper ERP or a tech.
Okay. So now there are a lot of changes or the amendments coming in for Indian accounting standards. So, sir, would you like to mention any of the recent pronouncement or amendments which are, I think, commonly applicable to most of the companies, and they should look at it, because at times it may happen that they are not keeping a pace with the changes coming in or the amendments which have already been done, and sometimes they miss out the required disclosure or the change in the books of accounts. So what are your thoughts on that?
No, so I think it's constantly evolving. IASB is constantly on the track as to what is the expectations of the stakeholders, and how do we address those expectations through the changes or the introduction of the new standards. So there are a couple of ones, which are coming. So there is 118. I want to discuss 118.
Yeah.
And then there are the disclosures, because internally the MIS, one performance evaluation can be based on the MIS.
Yes.
But now, all this reconciliation will have to be given. So like earlier, the segment, if the segment is looked at, how the segment is looked at by the chief decision maker, and that is what is the segment disclosure, and that numbers needs to be reconciled. Similarly, now there is performance evaluation, which Prashant can throw light on.
Yeah. So in terms of the amendments, generally last year has been relatively silent, but one major change, as sir was mentioning, is about 118, which is expected to be implemented from 1st April 2027, and it is going to be a significant change, and that is why the exposure draft is available 2 years in advance, and that will change way you look at the profit and loss account balance sheet, way it is presented. So one of the change which they are wanting is that the operating profit and loss has to be disclosed separately. Your income will have to be broken up into operating, investing, financing, and discontinued. So they want to have separate classifications in the income and the expenses, also similar to where you present the cash flow, because they want the user to very clearly know this is the operating profit and this is the non-operating profit, or these are the items which are due to investment activities or these are due to financing activities. That is one very, very important change which is expected to happen. And another expected change which is there is the measure of performance. So if you are using some other measure of performance in your generally communications with the outside world, those also have to be part of your financial statements. So from the way analysts are looking at it, and the companies use different terms, adjusted profit and loss account or some of those type of items, the financial statements also should reflect those type of items, so that the reader, when they are looking at a different communication from the management, and when they are looking at the financial statement, they are able to reconcile those numbers and have a proper understanding that what they are saying and how the financial statements are looked at. So this is another very, very important change which is going to happen, and several subgroupings and breakups will be required, aggregation and disaggregation, to reconcile all those numbers. So these are 3 or 4 major changes which will happen, though. So it is going to replace IAS 1, which is the presentation of financial statement, the entire format will look quite different. And it is applicable from 1st April 27, but the previous year numbers and other things will also be required, and hence preparation is required. It is at the exposure draft level. Internationally also it is going to be implemented from 1st January 27. So this is a very, very major change which is there. Of course, there is a change for the insurance sector, which is not very commonly applicable to most of the people for 117. But these are the two major landmark changes which may happen. Other routinely disclosure changes are happening, but last 1 year has been relatively okay.
Okay, thank you. So as we know that IND-AS has evolved from IFRS, and IFRS standards were adopted to make IND-AS initially, and there were some carve-outs from IFRS which were taken, and some exemptions were offered because the regulators felt that initially maybe in the Indian environment there will be some exemptions or relaxations which would be required. So whether those exemptions or relaxations have done justice to the Indian companies, and what are the exemptions which are most commonly taken up by many of the companies? Your thoughts on that?
No, so see, IFRS came early 2000, and we adopted, 10 years later. So when those were pronounced, we didn't have any. I don't think we would have made any representation. So we had no, communication in and around those. So to have look at from the India perspective and customize from Indian perspective, few of the relaxations were given, and rightly so. The first and the most important one is on PPE, because as per IFRS, it has to be IFRS cost throughout, right from the original the asset came into existence. So either it could be based on the IFRS cost, less amortization, or fair value. Now, Indian corporates are so many decades old, and to get into the original cost was always a challenge. And it's a very detailing exercise, and that was one of the biggest resistance which was from the corporates for accepting IND-AS, and hence that relaxation was given. One other thing which I can think of is business combination. So transaction under common control, and we have this unique court control scheme and all. So there was some relaxation which was there. I think I can think of these two, which were rightly institute thought about it and rightly given those relaxation. Anything else if you want to?
More or less similar to those only. One was
Sure.
this foreign currency convertible bonds were there, but that may not be applicable to many
Correct.
largely, but few large enterprises it would be applicable. So that was one. And similar to the corresponding exception, the foreign exchange gain loss. Earlier there was some amortization of the loss of foreign exchange which was permitted
20.
in couple of years through amendment of 46A amendment which was there.
Correct.
So that were permitted, and that for old transactions some grandfathering was
Was
permitted. So that type of amendments were
Sure.
there. And most of the companies have used the PPE exemption extensively. I think that has been one area where everybody has followed the deemed cost concept, except few where they wanted to bring the fair value of either land in the books of accounts for whatever other purposes. So that was an choice which was there. And business combination, rightly so, pooling of interest. I think India is still one of the unique where you have a pooling of interest, and even today IFRS does not have that concept of pooling of interest, even today. So that is one of the most, they are deliberating whether they should bring pooling of
Sure.
interest in IFRS or not. So that is where we were maybe a little ahead.
Yeah, but having said so, I would say now, these new standards are coming. So with this experience, we should be number one in the part of drafting those standards. That is number one. But if we are not, but as institute should give those kind of comments for this, so that we don't want a carve out, because carve out itself has a challenge. So if we can learn from this. See, earlier, as I said, when all this came, we were not, nobody would have looked at it because it was just beyond us and nobody thought that this will get implemented. Now, having gone into this, rather than, announcing our own standards or, having those carve-outs, we should insist, we should make those strong representations so that we don't have such, carve-outs.
Yeah. Yeah, that is true.
Okay, thank you. So as we have been discussing, there are many complex areas in Ind AS as compared to IGAP if we see. So for example, there is fair value measurement, then there is business combination standard, then financial instrument standard is there, consolidation process is different. So how the process has evolved or how this transition has evolved to handle these type of complex areas. So what would you like to say on this aspect?
Some of the complex areas which obviously revenue recognition is there. Some industries it was very, very complex. Some industries it would not have been very complex. Infrastructure, real estate, BILT contracts, toll, infra, all those areas it was more complex in nature. There it definitely took more efforts. Some of the areas the revenue did take a hit in terms of where discounts were forming part of the expenses and now they were reduced from the turnover. Provisioning for sales return, which strictly speaking under IGAP was required, but many were not following that practice because it was not very explicit. But that definitely made an impact that this provision for expected returns was made. So that did reduce the turnover of some of the companies. And those practices are now ingrained with most of the companies and it's a standard routine process. Business combination was one area where there were a lot of challenges. For example, if you have invested in a company more than 51% and you are consolidating, the consolidation you have to do the fair value accounting. And at that point of time, the standalone books of the subsidiary, you may have a different asset value and at consolidation, the asset values are different. Hence, recomputation of depreciation, corresponding deferred taxes and all those things is an area of a big challenge. Some of the smaller companies still use Excel sheets to handle some of those matters, which once it becomes more complex is quite dangerous because it is very, very error prone and the experience has shown that errors have happened in those type of calculations. Even if you are principally clear that this is the right way to do it, but while actually doing the calculation, the errors do creep in because either the discounting or the Excel calculations or when you actually implement it, those time errors do happen and the control over the year on year, because if you have a different asset base which is consolidated, when you do the opening balance next year, how does those number automatically flow in and have a control over all those type of things, because it's like maintaining a parallel books of account. And that has been my experience where a lot of errors have crept in, and as an auditor you need to be very vigilant, because I had an example where there was a different inventory figure in the standalone books and there was a different inventory figure in the consolidated books and the project was sold off. So initially the profit and loss was calculated based on what was there in the standalone, but suddenly then I realized that no, that figure is different. At consolidation the impact will be slightly different, but if you are a continuing auditor or you're a continuing person, you have that knowledge, you remember that. But if it is for the first time, there is a lot of chances that you are making errors because everything is outside the books. And the Excel sheets are obviously creating a lot of trouble. Some companies may have found a solution which are very large, but for majority of the companies, they have not found a solution to this type of problems. Fair value measurement, there have been challenges, but generally people do rely on the valuer's report. As an auditor, it is not only enough to just take the valuer's report, there has to be some due diligence on that, because it is not, it cannot be just said that whatever is given we have accepted it. So there is another challenge, how much you question, what do you question and what you don't question, and what steps do you take, and there the element of judgment and your risk assessment comes into picture. Splitting between debt and equity has been another constant challenge. For example, if there is a compulsory convertible preference shares, if the terms are not fixed to fixed, then there is a possibility that it is classified as debt or partially debt, partial equity. How do you split those? Whether you take external help of valuers or what sort of judgments are used, those are typical challenging areas. And how do you explain that to the promoters? How do you explain that to the audit committee people who are not chartered accountants that I have a compulsory convertible preference share. The people will say it's going to be converted only, and you are showing it as a debt. How are you going to explain that? That becomes a little bit of a challenge.
Okay, so two good points I think you made. First is opening balances, which we have to make sure that it is getting carried forward, and it is very important when there is a change in auditor happening, because it may happen that sometimes the earlier auditor have missed out any Ind AS impact, or the area where there is a some change needs to be taken. So I think when the new auditor is coming in, it is his responsibility to get into all those things apart from the opening balances verification. And this point, as you rightly said, and I think Vijay sir will also agree to it, that in the board or the promoters, the members who are sitting there on the top, so many a times it happens and the challenge is faced that they are not aware about the Ind AS terminologies or Ind AS nuances, and it is very difficult to explain them that why this is done like this and why it is not done like this. So sir, you have any thoughts to share, or maybe your experience from the audit committee side?
So, so let me wear both the heads as auditor and as audit committee. So, as auditor, what I used to do is, if there are any important changes which are coming, it is explained in advance, because this doesn't come overnight. So it is explained in advance, and such discussion happens with the audit committee, that these are the changes which are there, and this is what is going to be, this is going to impact, and why this is going to impact. So it is whenever such changes come, because as Prashant was mentioning, this other standard 118 coming after 2 years. So anything which is important, critical, it is important that as auditor it is explained to the audit committee. Coming on the other side is, it is also the responsibility of the audit committee to keep itself updated, not only through the auditors, but independent of the auditors, as to what are the changes which are coming. Management will also does the impact assessment, but how does the audit committee keep itself updated of the changing requirements? And this is the expectation, because audit committee members, at least one person is financially literate, and the one who understands and explains this to the other committee members if that is required. Having said so, as a company can make those working, how this is impacted, have these discussions with the auditors to evaluate that what is the stand, if there are options, and what options to be taken. And that is how the planning, and this is how I think from all sides, there is a lot of planning which is involved in, and specifically, for the listed company, when the quarter-on-quarter results are to be declared, and there cannot be any errors in those quarter-on-quarter disclosures, and hence all this planning becomes very important.
So as sir, you were mentioning that IFRS was implemented much earlier to when the Ind AS was implemented. So from the global practices, what are the learnings which Indian companies have to take even after 1 decade of Ind AS, or what all good practices which can be implemented in your views?
See, this is, globally the companies plan very well in advance. We have this habit of jugaad, and we don't normally, we work with the deadline in mind. Whereas, they plan well in advance as to what are the implications and how, this impacts. Of course, one other important is they deal in a different size. So they cannot, delay the matter, because lot of stakeholders are required to be taken into confidence. So if I, take that learning, if any, if there is any this, so the idea is that how do we plan well in advance? Don't have a jugaad, because auditors are busy quarter on quarter. Management, accounting team is busy quarter on quarter. So somebody needs to take out that time, understand what are the requirements, how does it impact, how the company is going to work out that impact, and then what is the continuing impact, because there would be any change which comes, so there is a first time implementation issues, right? And those becomes very critical this. So idea is that we should plan well in advance. And secondly, how do we use tech? First is one needs to understand before using. So initially would be manual, but how do we move back, to the tech? I think these are the two things which is important. And the third, and which is also coming, is any transaction which the company, any agreement which the company is entering. Earlier, Indian GAAP, it was not discussed with the implications as per Ind AS. Now it is getting discussed, and this has also taken time in Indian corporates to discuss with the company, to discuss with the auditors the implications of any significant or material contract. Because earlier it was very easy, whatever is given as form was important than the substance. Now the substance is important than the form.
Okay, thank you, sir. So, how the Ind AS has affected the transparency or the comparability of the financial statements for external users like investors, the other stakeholders, lenders? So, how this has made an impact on a larger scale?
This, I would say, has made tremendous impact, because internationally, they can read, so they understand Ind AS financial statements because they understand IFRS. So it's very easy. So if that understanding is there, the lender is willing to, would be willing to lend at a premium. Now that that premium is got eliminated, or a customer doing business with somebody in, reading Ind AS financial statements, or vendor, whoever. So all stakeholders are more comfortable in the way this is the financial statements are being read, and there is no premium on or discount on. We don't understand these numbers, and hence we should have some kind of premium or discount on this transaction. And also comparability of, when the one were to compare in companies in India and similar companies in similar sector outside India, that comparison becomes easier. And which is the company which is more profitable, which is the company what we can do as Indian companies, to increase the market cap, or, our market cap is higher. So, all this comparison has become, very easy because of this. So I think this is really, that was actually the main purpose why this IFRS or Ind AS was, stakeholders overseas were insisting on Ind AS numbers.
Okay. So as we discussed on the understanding of Ind AS to other stakeholders, Prashant Bhai, that they are not much aware about Ind AS related things. So whenever these challenges are faced to explain other stakeholders about how the accounting is done under Ind AS and why it was not done earlier under IGAAP, and if there is any major impact on an ongoing basis for the existing company which is already under Ind AS. So how, in your view, one can overcome these challenges to have a better communication or a dialogue with the other stakeholders?
Sir has partially addressed this question. One was planning, because if there is a transaction which is happening during the quarter, you need to be aware that this is happening before the quarter end. You need to discuss that transaction, and if there are large implications, then inform the promoters first in advance. So, for example, you have an associate with 22% stake, and you have sold 3 or 4% stake during the quarter. Now it is around 18 and 19%. Now there is a question of judgment which is going to come. Whether at 19% would you still have significant influence, or you do not have significant influence? What has changed? And there some element of judgment is required. Now those are the type of things, if you have identified identified in advance and discussed well in advance. First, understanding from the management what was their intention of diluting, what are the rights which are there, reading those documents, then forming the conclusion, these are the available choices, and informing the audit committee sometimes well in advance, because you don't want a situation that you have already formed up a position and the audit committee, the view is slightly different, because these are all subjective matters and there could be a different view which is quite possible. So these are some of the care and precaution that you need to take. Sometimes small file notes simplifying the impact may be presented to the promoters first, because promoters also don't understand the implication. What is going to happen because of this transaction? So another example which I can give is dilution in the stake. Again, when you have an associate or something like that and there is a dilution, you have not sold, but somebody else has invested in that company and your stake has gone down. Now there is a dilution, deemed dilution which has happened. Whether any accounting is required, not required, how do you do the fair value there? Because apparently from your books there is no transaction, but there could be an impact. And being aware about those transactions, addressing those transactions in advance is very, very important. And because sometimes it can have a very large impact. And from quarter on quarter it can really have a big swing in numbers if you have those type of transactions. So that there you should take adequate care.
So I think what you mentioned is very much relevant with respect to, as we mentioned in the audit report also, that we communicate with the management and those charged with governance. So I think here, how better you communicate with them about all these changes, or in a well-planned manner, I think that will be the key for an auditor to have these changes implemented. So now, as we move forward, so as we know that Ind AS is very much saying that it is always substance which will prevail over the form of any particular transaction, be it Ind AS 115 on the revenue side, or be it Ind AS 116 on leases, then financial instruments, Ind AS 109. So if legal form of a transaction differs from a commercial purpose, which one should be reflected in the financial statements to ensure that there is a faithful representation?
It's a difficult one. See, by and large, it is Ind AS, so it is a substance. But lot of times the court order comes into play. And then how do one deals with the court order is something which one have to look at it. If you go back in times, there was all the adjustments against the share premium, goodwill write-off and all this, which is now gone. Courts have rightly, they've been saying that whether this is in accordance with the accounting standard. However, if there are any changes, so those are the one area which is, by and large, I would say it is the substance which is important than the form. But one has to be careful, if there are some other implications. Also, let me give you, because this substance over form is, so let me give you a couple of practical things which, I had dealt with when as an auditor. So there was one transaction which was happening, which appears to be, it was a business combination. And the way the transaction was structured as a firm, a company A was acquiring company B. This was as per the court scheme and as per the firm. But when we went deeper into it, it was the reverse merger case. Ultimately, company B was acquiring company A. And this particular aspect as to what is reverse merger, I think that substance it is a reverse merger, but accounting, the challenges which comes in and around, and the acceptance from all the stakeholders that this is the reverse merger and this is not the business combination is something which one has to be. So whenever there is a transaction which happens, one has to be careful. The other side of it is, lot of times company has less than 50% stake, say 40% stake. But that 40% stake gives control. One has to evaluate. And lot of times one would find that even with 40% stake, there is a control and requires consolidation. And I've seen companies not implementing this because it's not analyzed. I'm saying the substance over form is very important and very always needs to be looked at. It's what are the implications. One has to actually go deeper into it. Once one goes deeper into it, then only this. The third could be, it's not what is the way that it gets control. So is it a control over the board or the control over the voting rights? And we have analyzed the voting percentages to come to conclusion that despite the 40% one needs to consolidate, or despite one would have more than 50%, it cannot be concluded because one does not control the board or one does not have those key decisions, control over those key decision makers, decisions where those one needs concurrence of other party. So I'm saying any transaction which happens, it's a substance one has to look at it. It's not the form that you have 50+% means needs to be consolidated or is not to be consolidated, and this needs to be monitored on an ongoing basis, because when one loses control, one does not know. If one loses control, then there is a different accounting. So I'm saying that substance over form is one has to be very there it comes, even the debt equity it comes, because that is one area. If there is a high leverage, there could be vendor or there could be lenders violation, some kind of terms which is getting vitiated. That could have impacts, and hence that also needs to be looked at.
Okay, so in continuation of this, when the financials are prepared as per this, keeping this concept in mind, substance over form, so how this can be explained to other stakeholders or third-party user of financial statements, or how better we can communicate that this concept is basically implemented in preparing the financials when they are unable to understand few of the things?
You will have to simplify and explain it to most of the stakeholders with suitable notes and disclosures. There is no other choice. And sir mentioned an example of a reverse merger. I can add on to that there were merger of 4 companies which was there, and if you go deeper into that, the objective of that merger was to acquire an asset. So whether it was an asset acquisition or a business combination, eventually that type of a situation also practically I have seen that initially first feeling, sometimes in the substance over form, the first feeling is that this is the right answer, but if you pause and you look at it slightly differently and go a little deeper into answer, lot of time changes, and that has been one of my very important learning, that the first answer sometimes is not the right answer.
The form is not the right, and you hit it on the nail. There was one transaction where there was a if there is a bargain purchase, then what one can do. So Ind AS is OCI and all, but IFRS, I was doing one IFRS where bargain purchase goes to P&L.
P&L account, yeah.
Correct. And lot of discussion happened, evaluation as to why so less, why this. And we were not comfortable. Client was saying that we need to take it to P&L. We were not comfortable, but we analyzed this transaction. Actually, we concluded it's an asset purchase and not a bargain purchase.
Yeah.
And hence it is a asset accounting needs to be done. It's not a controller.
Correct, yeah.
You hit it on the nail. I'm sharing this, practical experience.
But the key challenge is in explaining some of this not to the lenders, investors. They will understand some part of that, because now most of the investors are understanding the Ind AS accounting. I think because of the 10 years of journey, that is largely settled. Lenders also understand because they know their Ind AS implications. But the more critical part is explaining is to the tax authorities. That is the biggest challenge, because they do not understand this aspect. Because for example, if you have recognized the revenue which is different as compared to what is there in the GST records, then there is a different challenge to explain this to the GST officers, that why this reconciliation, why these differences are there. Those challenges are real, and most of the corporates are really facing those. Income tax.
Gradually coming into the non-OCI, the tax office will understand that.
people are not understanding the gratuity which is going in the OCI part. But at least that income tax is clear that payment basis it is allowed. So as far as you pay, it is allowed. For wherever you have debited, that is not a problem.
sometimes access among both and
Yeah. So that those reconciliations are creating real-time challenges, and I think as the time goes by, I think it should settle. But those challenges as of today still exist. Uh, Common shareholders may find it difficult. People who are not educated or who do not understand some of these terms will find it difficult. Retail shareholders. Uh, so for them, it is slightly complex. The large balance sheets, because one of the biggest problem which is now there is the size of the annual report and the number of pages. And yeah, so where do you really look for? What you are looking for is sometimes also very, very difficult. So even if we have to search, sometimes you use Control F and try to find out where you are going to get, because to go through such a large piece of document has itself become a challenge. So that is a real challenge which I think regulators are trying to address, between over disclosure versus balance in disclosure, and how to achieve that. But those challenges are live and those are still there. There is no real solution which has come out.
I think on this front only the accounting policy disclosure has changed recently from significant accounting policies to material accounting policies. I think that aspect is nothing but a
Yeah.
disclosure balancing, one can say.
But practically, I have not seen a very large scale impact of that change happening, because most
Yeah,
except was that
they have just changed the heading. Changed the heading.
it has not practically happened. Widely, it is because everybody is giving everything, assuming that sometimes something is there.
For example, financial statements disclosure, right? You have these accounting policies or FETPL is that they may not have in their financial statement any instrument which is fair value to profit loss account or through OCI. All accounting policies are continuing as is. So except for the disclosure part of it, which is a requirement, there is no material change in this.
So I think one maybe on the company side, CFO or someone, or on the auditor's side, I think each case needs to be evaluated, like what all accounting policies are applicable to my company, what all things I'm not using from last so many years, I'm just keeping it just because it has been copy pasted earlier. I think the purpose behind getting this change is nothing but that your accounting policies should reflect what your company is or what your business is basically. So on this aspect on the financials only, let us continue further that as the companies are preparing financial statements as per Schedule 3 of the Companies Act, and results are also published as per SEBI LODR format, the prescribed format. So at times there are situations where the standard requirement is slightly different than what is the disclosure requirement under Schedule 3 or CARO or SEBI LODR format. So how this is important and relevant from India's perspective, and how one can address this issue in a practical scenario.
So I think by and large these are aligned. Schedule 3 is, as per Ind AS. Schedule 3 is mainly the disclosure standard for the financial statements, and all the Ind AS standards gives the respective disclosure under those standards. SEBI LODR is also in that sense aligned, and if there are any overlapping requirements, then what is the requirement is one has to report on both the sides. I think the issue is, if I were to, think, and Prashant rightly, drew the attention, is related party, because related party is different definition under everything, and how do you align those definitions and ensure that compliance is. So no, it is the compliance and the disclosure, because it's different under Ind AS, LODR, you see, Companies Act, then income tax, transfer pricing, RBI. So, all these different related party definitions, and in those definitions could be aligned. I think that will be one of the ease of, compliance. And then more and more compliances in and around any transactions with related party transactions.
Because that reduces the chances of making mistake. Today, you may comply with Ind AS and your mind is applying only on the Ind AS, but it is quite possible that the SEBI LODR it is getting skipped. So I think we should try and have consistency because the errors get reduced, unintentional errors sometimes.
So, as we know, recently NAFRA or FRRB or QRB, they have come up with many of the reports or findings on the listed companies' financial statements, or even to the unlisted companies where Ind AS is applicable. And expectation of NAFRA in particular from companies' side or from auditors' side is that they have to be more vigilant on the disclosure requirement or the Ind AS compliance requirement. And on the audit committee side, sir, also they are now expecting that now auditor has to one-to-one communicate with the audit committee and those charged with governance, where the management need not be present in that particular meeting. So in real life, as you are having on the audit committee, or maybe you are chairperson of some of the audit committees, as per your experience, how this works in real life and how one can take it forward?
So let me tell you, one-on-one meeting with auditors happen, and it's very this what is expected from auditors to communicate in one-on-one meeting is something which is more ethical, but thing which cannot be discussed in front of the management. And that is, I see that what needs to be discussed is not, there is no clarity. And I have to repeat all the time is whatever can be discussed in the meeting, please don't discuss in one-on-one meeting, because nobody wants a repetition. Idea is that everything can be discussed in the meeting unless you have something which is needs to be discussed. Otherwise, focus everything in the audit committee. So that is number one. But one-on-one meeting happens regularly. What NAFRA and is saying is, and basically the focus of NAFRA is on the documentation, is from the auditor's perspective, and from audit committee perspective, is audit committee asking the right questions, and that is where they are going to come up. They have started the series, and whether that. So the idea is that it's not that audit committee should not be a silent member. They should ask those kind of questions, being independent. The experience of NAFRA, and based on this, is that normally audit committee members don't ask questions, and that is where it's a good series which NAFRA has started. So if there is some fear in the minds of any independent director, there is some, at least some regulatory backing saying that okay, I need to ask these kind of questions, and it gets documented. Having said so, NAFRA is mainly looking at the documentation from the auditor's perspective, and mainly focusing on the judgments and estimates which are made, and how those are documented, and how auditors have concluded this as a reasonable I would say NAFRA comments are welcome, but also NAFRA needs to, and this is something which is my personal view is, it is NAFRA is also responsible for the audit quality generally in the country, and it should not deter people from entering the profession, because if it deters, then the audit quality suffers. And that overall, responsibility of NAFRA is something which NAFRA is to look at it in a holistic manner. Reason being, I see a lot of people, they don't want to get into the profession, and hence, and if you ask the reason, what is happening is they read papers. I would say audit is one of the best profession in any business, any profession, any consulting. Everybody looks at the annuity business. Even the best of the consultants would want to get into the annuity business. Audit is an annuity business inherently. And with the way the regulatory requirement is there, that 5 years nobody can, once it is there, it is for 5 years at minimum. Otherwise, one has to resign, and there are different implications. So it's one of the best business to be in. Despite this, you know, so that is where the overall how do we improve the audit quality is it's all a joint responsibility of all of us, the institute and NAFRA being the regulator, the stakeholders. But the idea is that overall, that is what is NAFRA's role is to improve the audit quality, not only on that auditor, but also overall in the profession.
Very good point you have made, sir. So Prashant bhai, you want to add anything on this?
One or two more things. I think one, as auditors, you have to be more vigilant because you cannot miss the elephant in the room. I think that is very important. That is what looked at by most of the auditors. The most critical part is that you cannot miss the elephant in the room. If there is a large impact on the net worth, large impact on the P&L account, some large transaction, large related party transaction, large loan, large investment, those type of transactions is something that you cannot miss out, and you are not expected to miss out, and that is your primary duty. I think that is something which is fundamental. That is one part of it, and which is major. The second part of it is obviously the improvements in disclosures, compliances, that obviously it can get improved through proper checklist, proper technology, proper training. Those are the expectations which are there. The institute has come out with so many publications which are there. For documentation also there is a publication. There are common errors, there is a publication of the common errors. If you are able to look at that, you will definitely be able to reduce significantly. So that is the easier part of it, the disclosure part of it. But the more critical part of it is the elephant in the room, that are you missing out on the most important part of the duty and the role, which is the quality of the numbers, and how do you balance between the documentation versus the real audit. I think that is a critical challenge which is there, because over documentation you may do everything, but if you have missed the elephant in the room, that documentation is not going to be of any use. Yeah.
Yeah, thank you for sharing your thoughts. So I think with one question I would like to conclude this discussion is that what is the way forward from here on? Like, how do you see next 10 years of Ind AS, looking at other expectations of NFRA and other things which are in and around, you can say, this particular requirement or the subject. So how do you see next 10 years from here on?
So I think the expectations, more and more expectations of the stakeholders will come in from changes in the accounting standards. So that is number one, because the idea is that does it meet stakeholders' expectations? If it doesn't meet as accounting standards or auditors, then it becomes redundant and irrelevant. Something else will come in. So the idea is that, and that is how the accounting standards get on changing. So that will continue to happen. I think the role of auditors and the audit committee is becoming more and more important. Not only that because of the regulatory oversight, but also that is the expectations from the investors community. Correct. There are proxy firms, if you see, those are also giving comments on the audit committee. Right. There is a talk of, some rating of the auditors. So the idea is that all these accounting standards, auditors and audit committee, I think the importance of all this will increase in next 10 years. That is what I feel.
Very rightly said, because if you see the auditing as a profession with the level of responsibility, the expectation, I think it is a very good business opportunity also, because if you look at it in a right way, because with the expectation of the regulator, the responsibilities which are there, it is the right place to be in if you are able to discharge your duties in the right manner, and if you are able to invest and train your team sufficiently enough. So there is in my view, I have a very positive outlook on the entire way these things are evolving, because eventually it is leading to something which is better. That the issues which are we see right now, and if you are able to learn from some of these things, way we used to do audit maybe 5 years back that has also changed. The thought process maybe which was there last year has changed this year. Eventually every year you are doing some improvements, and as a profession eventually it is going to be better. But yes, we have to look at it things little more holistically and not very narrowly.
Okay, thank you both of you for sharing your thoughts and giving wonderful insights. So from this session, if we want to say that what are the key takeaways, so I think 2-3 things I would like to mention. So firstly, as Vijay sir rightly is mentioning since start of the session, that it is still evolving, so definitely we will have to keep on learning new things or the new changes which are coming in. Secondly, Ind AS is on the concept of substance or form or fair value measurement. So one can say nothing comes free, and based on that, the accounting and the financial statements needs to be prepared. And as we concluding remark, both the panelists have mentioned that next 10 years we will see more and more changes coming in the Ind AS or the other things which are in and around Ind AS. So we have to be prepared for it, and we have to continuously keep track on changes which are happening. So thank you very much, both of you, and I would like to hand over the proceedings to the coordinators. Thank you.